Hello and welcome to the launch of 2024's Global Public Investor Report, OMFIF's long assets and currency allocations and allocation intentions. I'm John Orchard, OMFIF CEO, and thank you very much for joining us today. After a brutal period where in some countries real rates were deeply negative for a while, in many ways public investors have been blessed by the return of orthodox-looking rates of inflation and interest. The inflation shock has perhaps got central banks out of the corner they were boxed in on super low rates and quantitative easing, and the reserve managers have been making unsurprising allocation decisions as a result. But we're also picking up some interesting undercurrents this year from the 73 central banks worldwide and the $5.4 trillion represented in our survey. My colleague Taylor Pierce will take you through the findings in detail in a minute, and then Nikhil Sangani will discuss them with Banco do Brasil, Amundi, and others after that. For example, we see confirmation of the renewed interest markets have shown us in gold, typically a commodity which does well in rising inflation environments at a time when that's on its way down. In addition to some specific pockets of demand, that's possibly due to a rising concern about geopolitical issues we're picking up in the survey. Also, people are starting to worry about the US budget, albeit not enough to dampen yet a clear rotation by reserve managers to the dollar short term, no doubt in search of yield. The renminbi, which has been inching up in our survey in recent years, has stopped rising short term and in fact gone into reverse in some places. Our survey respondents expect to hold more of it, though, in the medium term. And despite the much easier winnings on government bonds this year, we're also seeing a trend in terms of intentions for diversification in fixed income, which may benefit corporate bonds and other slightly riskier assets in the medium term. We're also seeing intentions to invest in sustainable bonds, even from institutions for whom that isn't the specific mandate, and we'll take a look at that too. In short, our reserve managers expect their current allocation strategy to be short-lived. My colleagues will explore that much more later. And please also feel free to send us questions for Nikhil's panel. It's a terrific audience today that you're among, of central banks from around the world, as well as asset managers, sovereign wealth funds, commercial banks, and others. We really welcome your input and engagement in the discussion today. So thank you very much for taking part, and thank you in particular to the survey participants who contributed to this important work. To kick us off from a market perspective, we're lucky now to hear from a market participant, Frank Scheidig, who's Global Head of Senior Executive Banking at DZ Bank, and importantly, he's also Deputy Chair of OMFIF's Advisory Council. Frank, great to see you and looking forward to hearing what you've got to say. Over to you.
Thank you very much, John. Thanks to your staff, thanks to OMFIF and all the participants in this very important service, which is now running over a decade. Some observations, some comments from my side. Not necessarily just the overall market view from DZ. My personal opinion is you outlined it already. If you see the geopolitical stuff and also the sensitivity that we are in a change of rate directions, at least we are going to kick off in Europe this month. We will see the first rate cut after a longer period of hikes and staying sidelined. If you ask me personally, I would predict we see at least 4 cuts this year, each of 25 basis points, and I could foresee another 2 to 3 similar steps early next year. And then after 1.5%, max 1.75 if inflation keeps down. I do expect another sidelined or quiet activity from ECB. It looks like the way the US is going for a long time period, we haven't seen that Europe is faster than the US will be. If you all see the economics, it's quite clear that they have difficulties to start cutting rates. That I would even put a question mark if we will see it at all this year, despite the fact that ECB will, according to my forecast, show us at least 4 of those steps. Having said that, there is also another discussion which is getting louder and louder. Even the alternative to the US Treasuries and its derivative market, as well as the currency US dollar itself, there is not much of an alternative in terms of debt and liquidity. But here's the but. The questions about debt to GDP and these record highs has been a broad discussion, not just among few. It's really a broad and serious discussion. And I see also not just sovereign wealth fund, even central banks who look into other alternatives where they can invest with liquidity. I would outline also the option and the possibility of large companies, large corporates with a wider part of, or let's say where no majority stakeholder or equity holder is in. I.e., I give some examples and don't nail me on the names. It's like Allianz, Danone, and those kind of equities, which I would predict and forecast will become also a target for those who are seeking and where the frame allows them to invest into even more from the public sector side. And that's across all three time zones. Probably we will see a little bit further and broader activity out of Asia Pacific here, but I'm pretty sure that this will happen over time. Meaning as well, the euro will not become as weak as probably some people think. The dollar probably not as strong as it could be, given then the rate spread. And also, I would also like to comment for those reasons on gold. Even it has not an interest, and John, you outlined it rightly, that precious metals, in particular gold, should come down in times where inflation is coming more to the target corridor around 2% of ECB, but that's not going to happen. I predict we will see new record highs here, and there is a very, very strong demand, in particular less than a handful very big central banks and let's put it this way, in their field of sovereign wealth funds are permanent buyers of every ton they can buy. And I would predict that this trend is going onwards.
Frank, thank you very much. An extremely useful tour of the horizon. Great to have you on as always. Looking forward to seeing you soon. And we'll now go and explore exactly these issues after we've heard the results from the lead economist at OMFIF, Taylor Pierce, who's going to take us through the findings. Then we'll explore Frank's points and others with Nikhil Sangani in our panel. Looking forward to that.
Thank you. Enjoy. Cheers.
Thank you, Frank.
Hello, and welcome to this year's launch of the Global Public Investor Report. This is the 11th edition of GPI. My name is Taylor Pierce. I'm lead economist of OMFIF's Economic and Monetary Policy Institute, one of the authors of this report, and I'm going to be walking you through the key findings. Just to start off with a bit of overview of the report. This year, we surveyed 73 reserve managers from a globally representative sample of central banks, whose international reserve assets total $5.4 trillion. In the report, you'll find chapters on the macro environment, asset allocation, currency composition, and ESG considerations, as well as ranking tables on the reserve assets of central banks globally. Moving now to the key findings, I'm going to start with the macro environment. We asked survey respondents this year what the most important factors affecting their investment approach are over a 2-year period, which you can see in the chart here. The most important factor is represented by the dark blue bar. The light blue bar shows the second most important factor, and the purple, the third most important factor. We see that inflation is coming down compared to last year, with 94% of respondents expecting inflation to be between 2% and 4% over the next 2 years. But we also see that reserve managers think inflation is going to be sticky, as 80% still listed as one of the top 3 factors, which you can see in the chart here, which will impact their investment approach over the next 2 years. The other side of that coin is policy rates, which you can see is the top factor impacting reserve managers' investment over a 2-year period. This is listed by 83% as one of the top 3 concerns. Separately, we asked reserve managers whether they think that equilibrium real interest rates will be higher, the same, or lower than their pre-pandemic levels. And we see that 80% believe that, close to 80% believe that interest rates will be higher than pre-pandemic levels. So we see that inflation and policy rates are not only short-term concerns, but also going to be impacting central bank's investment approach over the medium and long term. Moving slightly lower down the chart, you can see that politics has fallen as an acute concern this year to the 4th consideration. But if we move to the next chart, it is becoming a larger long-term concern. So the left side of the chart is the same chart that was on the previous slide, but on the right side, you can see that when taken over a 5 to 10 year time horizon, geopolitics is listed by 80% of survey respondents as one of the top 3 factors impacting their investment approach. And this is higher than for any other factor over a 5 to 10 year period. So clearly, we see that central banks are bracing for a more dangerous world. So how is this impacting their investment strategies? This year, we see that a larger share of reserve managers are looking to take on risk. The light blue section of the chart here represents the share looking to take on more risk in their investment approach. And we see that this share has more than doubled this year compared to last year, with nearly 30% looking to take on more risk. We understand this in the context of central banks struggling to generate inflation-adjusted return over the past 2 years, with the average portfolio return in 2022 among survey respondents totaling negative 1.1%. So many experienced losses. And last year, that increased to 4% average portfolio return, but that's still, when accounting for inflation, still meager real returns. How are they looking to take on more risk? If we move to the asset allocation findings, we see that fixed income assets are in highest demand this year. So this chart represents the share of respondents looking to increase, maintain, or decrease their asset allocation to these asset classes, with the green representing those who are not invested in a particular asset class. We see toward the top of the chart that conventional government bonds, corporate bonds, and quasi-government bonds are in highest demand this year, with a net 20%, approximately 20%, looking to increase their share of each of those asset classes over a 2-year period. We also see a large share looking to draw down cash. If you look slightly down the chart at the cash bar, the purple represents a nearly 30% looking to draw down cash this year. And elsewhere, in terms of equities or asset-backed securities, we see in general very little appetite for other asset classes outside of fixed income. Digging a little bit deeper into the fixed income findings, we also see evidence of further diversification within fixed income and particularly government bond holdings. Over the next 2 years, the share of respondents looking to increase their allocation to 2 to 5 year maturity government bonds is 44%, which is significantly higher than it was last year. In addition, we see 13% of respondents looking to increase their holdings of lower rated government bonds, which is up from 0% last year. And additionally, we see 42% of survey respondents looking to increase their holding of green bonds. So taken together, these trends suggest to us that reserve managers are looking for higher yield while still balancing capital preservation and liquidity considerations. So doing this through diversification within their fixed income holdings, and we don't see much evidence of diversification into other asset classes. Moving now to gold to continue on the asset allocation findings, we see that gold will continue to grow in portfolios. The net demand for gold has held steady over the past several years and has remained positive at hovering around 15% since 2021, which you can see on the chart here. We also see that the average share of gold in portfolios grew to 11% this year from 9% last year. We estimate that if the growth of gold in portfolios increases at the same magnitude as it did last year, we will see an additional $600 billion held in gold by central banks over the next few years. And the rationale for gold holdings listed by survey respondents is due to diversification and as a hedge against geopolitical risk. Moving now to the currency findings, which are quite interesting this year. We see over the short term, for all the talk of de-dollarization, that central banks are actually doubling down on the dollar. In net terms, 18% of respondents are looking to increase their holdings of the US dollar over the next 2 years. The net share of respondents looking to increase their holdings of each currency is represented here by the purple diamonds. And as you can see, the US is the highest, followed by the euro at 7%, net 7% looking to increase their holdings. This wave of demand for the dollar we understand as primarily driven by cyclical factors, with the survey respondents listing expectations for higher relative returns and a positive outlook for the US economy as primary factors, encouraging them to invest in US financial assets. But as you can see here, moving to the middle of the chart, the demand for Chinese renminbi has flatlined in net terms this year at just 2%. This is even more striking if we look at it in year-on-year terms. So this chart represents demand for renminbi, with the dark bars representing those looking to increase their renminbi holdings, the light blue looking to maintain their renminbi holdings, and the purple, those looking to decrease. And if you focus in on the right corner there, the 12% looking to decrease their renminbi holdings, excuse me, this year has risen significantly from 3% last year. And that 12% looking to decrease renminbi holdings is comprised, that includes, one central bank from every region in the world. In net terms, the 2% demand for increasing renminbi this year has fallen sharply from previous years, as you can see here, with 10% net demand in 2023 to increase renminbi holdings and around 30% in 2022 and 2021. We see this on the opposite side of the positive outlook for the US economy and higher relative returns there. We see relative pessimism on the near-term economic and financial market outlook in China. And we also see structural concerns on market transparency and geopolitics playing a factor there, with around 70% of survey respondents listing those factors as potential deterrents to investing in Chinese financial assets. It's important to note that over the long run, the renminbi has the highest net demand for any currency, with 20% looking to increase their renminbi holdings over a 10-year period, and that's higher than for other currencies. But for now, we do definitely see a bump in the road for the growth of the renminbi as an international reserve currency. Finally, to zoom back out, we asked survey respondents how willing they are to deploy their reserves in the event of a crisis or market volatility. And we see a clear bifurcation this year in reserve managers' willingness to deploy reserves. The chart here shows a sort of barbell effect, so a hollowing out of the middle and an increase in the share of those looking to deploy a significant or willing to deploy a significant share of the reserves, and an increase in the share looking to deploy little to none of their reserves this year. So both of those shares on the more extreme ends increased. This is in line with our another finding that we see in our survey, which shows that a growing share of central banks favor swap lines or IMF facilities as opposed to drawing down their own foreign exchange reserves in the event of a crisis. At the same time, more central banks seem to be posing the question, if we aren't prepared to use our reserves in a crisis, then what are they actually for? So this is an interesting development this year, which we look forward to following in the coming years. Just to wrap up the points I've shown in this presentation, the key findings or key takeaways from this year's Global Public Investor Report are that central bank reserve managers are bracing for sticky inflation, higher for longer interest rates, and geopolitical risks. On their asset allocation decisions, we see a measured risk-on attitude and diversification within fixed income holdings. And in terms of currencies, we see higher demand for the US dollar over the short term with expectations for longer term currency diversification. Be sure to check out the entire report. There's a lot more that I didn't get to cover here, including our analysis of ESG and sustainable investment among central bank reserve managers. We also, as I mentioned, have rankings tables where we rank central banks around the world based on their reserve assets and track those year on year. And we have external contributions from a number of central banks as well. So be sure to download the report via the QR code here. And with that, I will pass on to my colleague, Nikhil Singhani, who will be moderating the panel discussion. Thank you very much.
Thank you, Taylor, for taking us through the key findings there. My name is Nikhil Singhani, the Managing Director of the Economic and Monetary Policy Institute at OMFIF. And for the next hour or so, I'm excited to explore many of the themes and points that we've just heard that emerged from this year's report with a wonderful panel of experts. And I'd like to invite them to turn their cameras on to start the discussion. Today joining us is Didier Borowski, Head of Macro Policy Research at Amundi Institute, Sonyan Zoe Liu, Maurice R. Greenberg Fellow for China Studies at the Council on Foreign Relations, Ricardo Martinelli, Senior Advisor on Foreign Reserves at Banco Central do Brasil, and Antonella Pecci, Head of Investment Strategy and Credit Risk at the Bank of Albania. Thank you, each of you, for joining us today for the discussion. Before we get stuck in, just a few points of housekeeping. First, Ricardo and Antonella have requested to mention that their comments today will be coming in a personal capacity rather than reflective of the institutional views of their central banks. And otherwise, as John mentioned at the start of today's event, we would like this to be an interactive and engaging discussion with the audience. So I'll encourage you to post your questions in the chat box. I can see already a few of them have started to come in. It should be on your screen on the Slido panel. And I'll try and get through as many of the questions as I can with our panelists today. We'll be touching on 4 key areas over the next hour, which are linked to the 4 main chapters of the report. That's to say the macroeconomic environment, the asset allocation intentions of reserve managers, their thoughts on currencies, and we'll touch on a bit about ESG at the end. So with that, we can get started into the crux of the discussion. And Didier, I'd like to start off with you and building on some of what we've heard on the macro environment, where reserve managers are slightly less concerned about inflation, at least in the near term, than they were a year ago. However, it is a major factor in their decision making, and one of the key factors they're looking out for, again, primarily in the near term, is the outlook for policy rates. And we've just heard from Frank Zeidig from DZ Bank about how he expects 4 rate cuts from the ECB, perhaps none in the US. How are you assessing this rate and inflation outlook for major economies?
Yes, I do agree with what was said regarding the ECB. It's quite easy for the ECB to justify 4 rate cuts this year, given the level of yield and the fact that the disinflationary trend in Europe has been more pronounced so far than it has been in the United States. That being said, I think it's the picture is probably clearer for the first rate cuts than for next year. Just want to say something is that when you look, for instance, at services inflation, it is still sticky. You still have no productivity gains in the Eurozone, and unit labor costs are quite high. So it's a good proxy, I would say, for core inflation next year. So my point is that there is no preset path for monetary policy. I do expect Christine Lagarde to repeat that on Thursday, that it will be determined data dependent, as they used to say. So that will be clearly related to the inflation path. That is quite a known for next year. But we do believe that in fact inflation will return to 2% by the end of 2025 in 2026, and it does already open the door to several rate cuts. The first one on Thursday is already fully priced in and expected, but now the key question is what's next year, this year, and we believe that 4 rate cuts is something possible. For the United States, I tend to disagree with what my colleague Frank Shedid said. I mean, there is also some room for maneuver to also Fed to start cutting rates. That's true that inflation is much stickier in the United States than it is in Europe. But that being said, we do believe that, in fact, domestic demand is going to slow significantly in the second half of the year. And given the level of yield and the gap between the neutral rate and the current level of yield, the first rate cut is also quite easy to justify. So we expect 3 rate cuts this year. It's much more than what is currently priced in, and that is something that could have an impact, on asset allocation, in particular on exchange rates. Looking ahead, all in all, we see resilient growth to continue at a global level. Growth is resilient, but multi-speed growth with very major divergences between business cycles across the globe. And here again, that's something that can give some opportunities to investors to position themselves, in particular on the fixed income market.
Yep. Thank you for that overview, and we'll come on shortly to what it might mean for asset allocation. But yeah, a relatively dovish view outlined there from Didier. Ricardo, from the way you're seeing things, I guess one message is, as Didier mentioned, central banks, well, in the Fed and the ECB and major central banks are in data dependent mode. I suppose that means on your side, it's probably quite difficult to take a clear view as to what might be going on. I suppose the first question is, in the near term, does that finding that policy rates and inflation is the key macro driver in terms of investment decisions, and how are you viewing that space right now?
Well, good morning. That's very challenging and difficult to come up with a strong forecast on what's going on in the US. So market was pricing 6 cuts, 2 cuts, 4 cuts, 1.5 cut now. So it's changing a lot, and it goes in a way that I think it's better to think that longer term inflation will probably be higher than the one that we had in the last 10 years. So it seems that we are clearly changing a regime. We do have very important and structural factors pushing this direction. So you have the demographics, restriction in immigration. You have defense spending going up, so the end of the peace dividend. You have energy transition pushing prices in many places. You have the deglobalization, which means changing supply chains, not necessarily with those becoming cheaper. So longer term, you have several aspects that will be pushing inflation to a different level. That does not mean that this is going to happen on a linear base. That does not mean that we can have good numbers in a year for 2 or 3 years in a row. But it does make it more challenging for central banks, because the way they see things in the last 10 years, it's probably changing now. We do have fiscal spending pushing growth and wages and inflation, particularly in the US, in a way that has been very strong. We do have the more on the short term. The financial conditions are still very easy. AI is contributing for that. So it's been very challenging to forecast short-term inflation. I do think it's coming back close to the target, but not as fast as everyone was expecting before. But then not necessarily will stay there. I think it's been and will become very important and challenging to forecast that in the next few years.
Yeah, thank you for those insights. So yeah, you've mentioned many factors that might be pushing inflation structurally higher, and I suppose one consequence of that is perhaps we're in a higher for longer rate environment. Actually, one of the key trends key findings from this year's report is that 78% of those central banks we surveyed say they expect that rates are now higher, structurally higher than their pre-pandemic levels. Antonella, I'd love to get your thoughts on this, either something around how you're assessing the rates and inflation outlook, or are there other macro factors that are shaping your thinking on the investment decisions at Bank of Albania?
Yes, policy rates are one of the most important factors that we consider in our analysis. Our expectations for the rates for this year are to remain at a higher level, even though we are expecting lower rates compared to the beginning of the year. And we are expecting lower rates in the second half of the year. For example, for the Eurozone, we expect a cut of 25 basis points in the meeting of June, but we were also expect until the end of the year at least 3 other cuts. So on this point, we are taking into consideration also the economic growth. For example, for the European Union, the economic growth is, let's say, it's most for the Germany. We have growth, but it's relatively lower, and these high rates might impact it. So this might be the reason. For example, for the United States, what is very important is the high level of debt, and as well as the impact that these high rates might create on the sector of commercial real estate. So even for the United States, even though inflation is we expect that the rate of inflation will get lower. For both these big economies, we expect rates as well we expect soft landing, but for the European Union, let's say a bit more sustainable, because inflation is coming down more consistently.
Thank you. Yeah, so it seems like there's some consensus here between yourself and Didier on 4 cuts for the ECB, but yeah, potentially some risks on the US side for growth is one way of reading that, perhaps.
Yes.
Already there's been a mention of deglobalization by Ricardo, and I think that'll be a good point to bring Zoe into the conversation, and maybe give some perspective on how you see US-China relations and the geopolitics there. Of course, we've had the announcement from the Biden administration on fresh tariffs. We've got, of course, the US election coming up. How do you see the landscape there?
Yeah, thank you very much for having me. I would just start by picking up on the trend of monetary policies. I would say that the current trend is very much different from the scenario, the situation when we experienced it during the global financial crisis, because in those days, central banks were including the PBOs, the People's Bank of China, they mostly work in sync, whereas now we do see a divergence, and in particular, as the Federal Reserve is still keeping a close watch on the inflationary upward trend of inflation, things are very different in China. And if I remember it correctly, in March, the PBOC did not raise the rate at all, but keep it unchanged. And given the current economic activity situation in China, and in particular the recent number of the PMI index, it goes to show a lot of mixed signals there. So perhaps the chances for the PBOC to keep the rate unchanged or even cut the interest rate throughout the year, the chances for that is much higher than say the PBOC is going to raise the interest rate and increase the funding costs. And this is going to have significant implications for the pressures on the renminbi as it's traded against the US dollar and other major currencies. Obviously the downward pressure is very much high, and people are even making a lot of argument to say, well, probably the chances is the risk for the renminbi to devaluate further, and perhaps the PBOC may devaluate the renminbi. The chances is higher, but I would offer some caution against the idea that the renminbi is going to perhaps devaluate even further, because if we remember the time around 2015 when the PBOC devaluated the renminbi, you started to see a lot of Chinese companies to repay their dollar-denominated loan. So, and that basically contributed a significant amount of capital outflow, and so and that would also, a devaluation of the renminbi would also work against the Chinese President Xi Jinping's emphasis on not only building up the strength of renminbi as the international currency, but also building up China's financial power. So from that point of view, I do see that the understanding China's monetary policy today is not just cannot just purely through the lens of macroeconomics and monetary policy per se, but also wave in some considerations of geopolitics. And now on the geopolitics part, you are right that the Biden administration indeed not only continued the previous Trump administration tariff, but also waived or slashed new tariff on Chinese goods, and in particular electric vehicles and batteries, things like that, or including medical devices. But I would say the damage on U.S.-China trade is not in terms of the current trading pattern, because the United States does not really import any significant amount of electric vehicles from China, right? It's very minimum. But the trend or the meaning of the tariff really comes down to basically trying to negate future growth potentials in the areas where China currently have what the West consider as overcapacity, such as EV, solar panels, solar cells, whereas from Chinese policymakers' point of view, they do not think China has an overcapacity issue. And the measurement benchmark is very different, because when the West considers China has an overcapacity issue, they are basically talking about China produce more than its domestic market can consume. Whereas when China talks about China does not really have an overcapacity issue, they are talking about the global market. And in a way, if you think about the way that China started its solar panel industry and EVs, they really built up for the purpose of export. So so it really depends upon the policy end goal. If the end goal is to have cheaper, good quality EVs for the global to fight global warming, probably it's not a bad idea to have China being a major supplier. But then having China produces for the world, it diminishes the opportunity for other countries. So it's a delicate situation.
Yeah, I think delicate situation is probably it's probably, to put it mildly, in many ways. But it's thank you for sharing those insights. I think we'll come on to a bit more about the renminbi and how central bank reserve managers in our survey, and how well, perhaps Ricardo and Antonella are thinking about the currency shortly. I want to move on the conversation to asset allocation first before we touch on currencies. And we headlined this year's Global Public Investor publication with a theme of stick or twist. We know that the majority of central bank assets are in fixed income, and we wanted to get a sense as to will they stick with fixed income, which are now higher yielding, or will they twist and diversify to new asset classes. In a way, the trend we have seen is both stick and twist in some ways. So it's a sense of sticking with fixed income, but diversifying within that asset class. So more demand for quasi-government bonds to corporate bonds, even green bonds in many cases as well. And Ricardo, I'd like to come to you first about how, well, firstly, your initial reaction to that sense of diversifying within fixed income, and if that's something you think makes sense against the current macroeconomic backdrop.
Well, I think, as many was saying last year, fixed income is back. You have a move of many investors, many pension funds moving away from traditional instruments towards alternatives, searching for yield. And somehow you have now short-term fixed income offering you a very good yield. Can't say low volatility, but so I think fixed income is definitely here as a very strong and good alternative, especially for central banks. But if you take what we mentioned before, if you are expecting inflation to be higher, somehow you have to add that on the equation on how to hedge and how to prepare your portfolio for that. You can find some ways within the fixed income space. So inflation link, it's an alternative. You can, as you mentioned, move to corporates, searching for some spreads, but spreads have been really tight. So that's a challenging move. You have to consider that we are in a higher volatility environment, which means for some central banks, especially the ones with smaller reserves, having more liquidity can be more important, so they can invest, they can act in their FX market whenever it's needed. So thinking about asset allocation, I would say fixed income, some inflation protection, liquidity, especially because liquidity is not costing a lot to own these days. Gold makes sense if you consider the geopolitical risk that has been extremely important in the last months and should be here to stay. Looking ahead, a combination of public and private markets, I think, will make sense for the central banks. I don't think many are investing there. But if you are moving to a space when inflation is becoming more and more important, alternative markets some of them offer a good hedge for that.
So is that, are you referring to sort of infrastructure, real estate?
Yes.
Okay.
Exactly. So there will be a point that central banks will start explore, as they have been exploring corporates in the last few years, and it was very challenging 10, 15 years ago to think central banks will be investing in corporates. So it's a natural diversification and evolution of the industry. So I think this, in the next 5 years, will be something that few central banks will start look more carefully, especially if you have this factor of inflation hitting your portfolio somehow.
Interesting.
And
yeah.
We'll discuss later, but it does make sense to have some ESG in your portfolio. It's a hot topic. It's some assets are benefiting from that. So just to finalize here.
Yeah, interesting. That's yeah. I mean, I think from the surveys we see, there's very, very few central banks who invest in those alternate asset classes so far. So it's interesting that might be a way forward. Certainly, when we run our parallel survey for pension funds and sovereign funds, I think in the last 2 years, infrastructure has been the most popular asset class linked to having that inflation protection. So yeah, it's interesting to hear that might be an avenue for central banks to explore too. Just very quickly, actually, if I could come back to you, Ricardo, on the point that you mentioned on the exposure to corporate bonds in particular. You were one of the co-authors for a piece in this year's report where it was mentioned in passing that you have exposure to the US stock market and also to corporate bond ETFs. You mentioned that the corporate bond exposure has actually been quite challenging. I'm wondering if you could maybe give a word to that.
Yeah, so in our case here, we do not invest in single names. So we're not comfortable buying specific companies. That works for equities and also for corporate. So for both, we use ETFs to have exposure. As you can see in our 23rd report, we have about 1% or a bit over 1% in equities, and the same for corporates, mainly in US. We do that using a group of ETFs that we selected. Liquidity is okay for US. For Euro corporate ETFs, it was way more challenging. It was not as easy as we expected. But my point moving forward, and again, I'm talking about investment grade corporate, not high yield. The spreads are not huge as they were in the past. So I think it does make sense, but you have to consider that you are adding volatility with not a huge premium to the portfolio. So the same has been happening to SSAs. So agencies, Supras used to pay much better spreads in the past. It has been tightening and tightening, and it's been tightening for over 10 years, and it's not exploding yet. So if you're not that, you are giving up all this carry. So it's just a matter of an aspect to be discussed when central banks will get their SAA meetings. If it does make sense, and consider that the premium was not as high as it used to be in the past.
Yep, thank you. Anton, I'd like to hear your thoughts on anything on what Ricardo just mentioned, or how you're looking at strategic asset allocations generally.
I agree with Ricardo, actually. I also see the diversification of central banks, mostly in the area of fixed income assets, because there are plenty of opportunities now. And diversification in the current environment in which we're talking about volatility and rising geopolitical risk, diversification in these cases doesn't give the result that has been evaluated in normal conditions of the market. So central bank will be prudent in diversifying in non-traditional asset classes. Another source of diversification might be gold, because gold is performing very well, has had an exceptional performance, and as well as diversification in another currency. But what is important is that central banks will be very prudent and cautious during this period in diversifying. So regarding the fixed income possibilities, might be, of course, in the corporate bond market, as well as MBS might be an opportunity. And depending regarding the short-term period of investment, it depends also on the expectations on policy rates, and because some central banks might take a longer duration, and it depends also on the expectation of economic growth and connected with the rate of inflation. But from what I see, also it's important to mention that rise on geopolitical risk, which we will talk about later, because generally we analyze geopolitical risk in our stress test scenarios, but currently the probability of these stress test scenarios has increased. So in the short term and in the long term, it's not quite easy to predict the behavior of the market and also policy rates.
Yeah, you touched on it earlier. I'd be interested on the role that gold could have within that. I mean, you mentioned that you run a few stress test scenarios. It'd be interesting to hear what goes into that, and would that justify, if there are more volatility or more stress in markets, or the geopolitical backdrop, does that then perhaps justify the looking into assets like gold, for example?
Yeah.
Great. And Didier, I think you've heard from the two representatives from central banks that they think diversification within fixed income makes sense. Is that a view you share as well?
Yes, yes, indeed. And bonds are back. That has been our mantra over the past, I would say, 12 months. Bonds are still back, and we believe that it's even time to be long duration. We have to be very cautious on that because and we must be very agile. But basically, our expectation for long-term interest rates by the end of the year are if you take, for instance, the US, we expect a significant drop, in fact, in bond yields on the long end of the curve. So that's an important factor to bear in mind. But you have also to understand that this new form of globalization that we are seeing, it's not an outright deglobalization because the share of trade to global GDP has not changed that much, I would say, since the invasion of Ukraine. But it's another form of globalization where you see, a kind of reshoring activities in some, countries that are more politically aligned with your own values. That's all about reshoring. So you have what does it mean? You have winners and losers in this environment when you observe these things, and you can still have a look, for instance, at FDI flows that tends to go in certain countries, and it tells you something about the new form of globalization that we'll get. And that's something that is interesting because it's something that probably will increase the decorrelation between business cycles. I mean, we are no longer living in a world that is driven by the US economy. You have domestic demand that is increasingly important for many emerging economies. And in practice, it means also that you may have decorrelation between monetary policies between countries. The fundamentals of several economies are very different. And we continue to see, by analyzing the situation on a country-by-country basis, some interesting investment opportunities in emerging markets, our currency in particular. So I think it's an important point to make. And so you have value within, I would say, the fixed income space with government bonds in Europe and in the United States. We would expect a steepening of the curve by the end of the year because you have probably more value on the short end of the curve. You still have value, but for carry reasons on the corporate bond markets. I do agree with what was said. We do not like really the high yield segment. And you have also to find some diversification by increasing, the share of emerging bonds in your asset allocation, in particular as of today in hard currency, but probably we'll have the door will be open also to add some exposure later this year to local currency debt.
Great, thank you. Yeah, Ricardo, I could see you nodding along there. I don't know if you could add to that, and then we'll come to Zoe.
Yes, so when we think about not deglobalization, but regionalization, that would be a better term. It does make sense to have exposure to the places where they are producing, so the places where the supply chain has migrated. So that goes in the EM space. So if you understand which countries are benefiting from this new redistribution on factories and also on commodities. So if you have a higher inflation, higher commodity prices, also linked to geopolitical issues. So it does make sense to have some exposure to EM. Always doing the homework because each EM country has a reason to be EM, not DM. But it can pay off if you choose carefully and it goes in the direction of some diversification of currencies.
Yeah, thank you. So I think there's many themes there that have just been mentioned on deglobalization, on commodities, and how they're being traded. That I think are topics that you've covered many times in the past. I was wondering if you could maybe share your views. I think this would be a good time to talk about the internationalization of the renminbi more broadly. On that point about how commodities are perhaps increasingly being looked at by the Chinese authorities to be priced in renminbi. That's something that you wrote in a fascinating piece for the GPI article itself. I was wondering if you could go into a bit more details about China's strategy to develop an alternative to the dollar and how commodities plays into that.
Right, thank you very much. I'll start quickly by sort of following the trend of our conversation on the asset allocation part. And I think to the extent that people are thinking about that China has been developing an alternative, and in particular through the lens of the PBO, the People's Bank of China, a noticeable trend is not just is that while China has been keep buying gold for, I think, increasing its gold purchase for at least 18, so far for 18 months now. I think May, the numbers, well, they purchased a little bit less than April, but the trend is 18 months continuous buying gold. And then while China expanding its purchase of gold, it has also been reducing its holding on its holdings of U.S. Treasuries and the agency bond. And if I remember the numbers correctly, I think by October last year, China's holding of U.S. Treasury bills reached a 14-year low. And then if we take a longer time horizon as it stands now, compare with 2021, China's holding of U.S. Treasuries decreased by about 25%. So this this seems to fit into the broader conversation about China has been initiating de-dollarization strategies or developing an alternative centered around the renminbi. But I wanted to first and foremost pointing out that China is trying to promote the broader use of renminbi, but the mechanism the purpose is not to dethrone the US dollar, but instead, a lot of this is really about risk mitigation to hedge against the potential sanctions. And then obviously, it's really about managing the risk, right? And in terms of China's strategies to develop, and in particular through the lens of commodities, the important aspect, and I think perhaps has been a little bit underappreciated among Western scholars, is that Chinese scholars and policymakers, they do view the energy transition as an opportunity for China to increase the pricing power of the renminbi in global commodities market and potentially make the renminbi a broader acceptable currency, at least for international trade and the cross-border settlement. And the reason or the mechanism behind this is that if we think about the existing world, about 80% of the global economy right now is dependent upon hydrocarbon and oil in particular. And when we think about oil, it is the global oil market. There is only one global oil market. It doesn't matter where you trade. Even if you are trading renminbi-based oil futures in Shanghai, it's still very much linked to the rest of the world. Whereas when you think about other commodities, in particular, critical minerals, which China dominates both the processing and refining, as well as some of the extraction technologies.
Does that say like the rare earth metals, for example?
Exactly,
yeah.
Rare earth metals and other critical materials that are necessary for example, like copper or cobalt, or for that matter, rubber, right? So a lot of these mechanisms, it's not that they are not traded in a global market. There is no one global market for cobalt. It's a very much fragmented market. And this is where China sees the opportunity to sort of step in and increase the renminbi's pricing power. And apart from that, I think China has also been developing renminbi-based financial infrastructure. I think right as it stands now, many people are familiar with the CIPS, China's cross-border interbank payment system. And the infrastructure combined with the use of digital renminbi, basically it allows China to have a totally different financial infrastructure to facilitate the use of renminbi between China and its major trading partners.
Yeah, thank you. It's just to follow up very shortly, there was an interesting quote that you had in your piece for the report, saying expanding the use of renminbi in trade is less challenging than increasing its status as an international reserve currency. I was wondering if you can expand on it, that you've mentioned CIPS and how commodities might be priced in RMB, but that might not then necessarily be reflected in its additional use in reserves. How do you see that? playing out?
Right. So I do think that we probably need to relax our consideration in terms of to what extent China really wanted to make the renminbi a reserve currency, and part of the reason is because that in order to become a reserve currency, I think you really need to have the associated renminbi denominated asset in order for foreign investors to be willing to hold renminbi, whereas as it stands now, it seems that there is no Chinese policymakers learning from the experience of financial liberalization experience of Japan and Korea. That's not something that Chinese policymakers is willing to make the step forward. That is too big a leap of faith. And then on top of that, if you compare the renminbi denominated or the Chinese government bond denominated in renminbi, it's still very much not as far. It falls far below of the market depth or liquidity of the U.S. Treasury market. So in other words, the asset side of reserve currency is for the renminbi is not there yet. However, China has been, the PBOC have been signing currency swaps with so many central banks. That's another practice very opposite to the U.S. to the U.S. the Federal Reserve. So from that point of view, if China were able to facilitate trade using renminbi, you can, and at the same time being the largest trading partner for more than 100 countries in the world, you basically can consider China as the Walmart for the world. And the availability of the renminbi as a credit line through the swaps is basically like a big store credit. And you have store credit so that you can buy it from this store. You don't have this store credit so that you can buy it from elsewhere. And I think from China's perspective, given that its economy is still very much export-driven, export-oriented, the idea of having a reserve currency is secondary to, first making the renminbi a broadly, more widely acceptable international currency for trade settlement purposes.
Yeah, fascinating. Yeah, I like the analogy on Walmart there. It's and I suppose some of the findings from our survey corroborate some of what you've just mentioned. When we asked the central banks what are the biggest deterrents to investing more in Chinese financial assets, the most popular answer by, I think it was over 70%, said market transparency, and I think capital controls was mentioned by quite a few as well as geopolitics was up there, mentioned by a few. Ricardo, you're based in a country whose biggest trading partner is China. I'd be interested to hear your views on the currency or on the dollar as well, which I think is the currency that takes up the lion's share of your reserves right now. How are you seeing the dynamics between those two currencies?
Yeah, dollar is our base currency, so most of our reserves are invested in US dollar. It's about 80%. Currency, it's a challenging discussion now, because if you look at what makes sense on the economic point of view, I guess US would probably suffer because of the fiscal spending that market is starting to pay more attention to it. So longer term supposed to wait on the currency. The deglobalization would probably benefit other currencies, especially smaller allocations such as Canada, Australia. I know some central banks are investing in Korea as well, and even EM, as I mentioned. China, it's interesting because if you think on the economic side, short term, it was not a good pair of years for them, but the way I see, they're successfully changing what they are exporting. So EVs are a very good example. From one day to another, we see an explosion of Chinese electric vehicles here. Yesterday, I read something that Germany has also seen a huge increase in imports from those cars from China. And so they are exporting value, they are investing in technology, and it was mentioned here that there is value there. What hits them, it's the geopolitical issue. it's pretty hard to see how this will play out. I'm not an expert on the region and on what's going on with Taiwan and Russia and so on. So you have to consider that for sure. But on the benefit of Chinese market, rates are way more stable. Volatility is lower than the others. The premium is not as nice as it was a few years ago because their central bank was already moving towards more expansion monetary policy. So the way I see it, you should diversify a little bit. You have to consider both forces, one pushing towards more diversification, but also acknowledging that all the risk-averse moves will benefit the dollar and so on.
Yeah, and I think in many ways those trends you mentioned are shared more broadly between many of our survey participants, where we see near-term demand for the dollar linked to maybe the broader macro uncertainty, but also the simple policy rate divergence between perhaps higher for longer in the US, but also as I think Zoe alluded to at the start, the fact that the PBOC have kept monetary policy relatively loose, and that dichotomy there, but also that there is a sense amongst many of the central banks that they would like to diversify towards China over a 10-year horizon. Actually, when we asked the central banks where do you expect the share of reserves to be in 10 years time as global share, the dollar was expected to decrease from just under 60% now to about 55%, and renminbi from just over 2% now to 5.5%. So it seems like over the long term, that's the expectation of gradual de-dollarization, but a gradual move to renminbi. Yeah, Antonella, would you like to come in on that?
Yeah, sure. We as well have RMB in our currency composition. We have almost 3% of our reserves in this currency. We added this currency when the IMF added it on its basket. And after careful analyzing of the currency and the economy, because we are talking about one of the most important economies in the globe, we considered the benefits of diversifying in this currency. What is our concern right now is related to, well, the expected slowdown in the Chinese economic growth, as well as the issues that we have seen on the real estate sector, which we considered there are issues of a certain level that might impact the economy as well, and the rising geopolitical risk. What I do think is that these issues make the currency not to benefit as it previously did, because central banks and asset managers will be more prudent in deciding whether to increase the level of this currency on the portion, how much to increase it in their portfolios. But what plays an important and crucial role for this currency is the importance that this currency has in the global trade and economy. And even in the data that is published by the IMF of the total foreign exchange reserves, I see that are held from the official institution. I see that from the fourth quarter of 2021 to the fourth quarter of 2023, there is a decline of the allocated reserves in this currency. So this is a sign, let's say.
Yep, it seems like the growth in renminbi holdings has stalled. It seems across central banks.
It doesn't show the same rhythm as it used to have before.
Yep, and through our survey, it seems like that trend will probably continue in the near term. Yeah, one of the big findings is that the demand for renminbi looks like it will flatline, which I think based on many of those factors you've just mentioned is probably the reason. We have a question from the audience, and I'd encourage you to keep posting them in just on the renminbi, and then following that, I'd like to touch on the euro very briefly and come to Didier after that. But there's a question here about what concerns should we have about the renminbi, given the divergence between the onshore spot rate and the PBOC's fixed rate. I don't know if there's anyone on the panel who'd be able to answer that? Ricardo doesn't seem to think it's an issue by the shake of your head. I don't know, Zoe, if there's any.
I can take a first crack at that, and I think the question is an important one, because the widening gap between the onshore and the offshore band seems to be a worrying some, and it has also prompted some argument even among currency strategists, to thinking that the eventual break of the peg is inevitable. I would say that, yes, the PBOC have relaxed, allowing the band, especially at the onshore, to be widened a little bit, especially in recent times, considering that the PBOC is trading at record low as of the end of last month. So from that point of view, I would say, yes, the pressure is there, and the devaluation pressure is there. And if somebody is trying to contemplate like a currency attack strategy on the renminbi, probably that is one important indicator to look at. The further the gap, the band, it seems the more likely that it's going to break. But I would caution against that kind of strategy, and part of the reason is because if you think of how much foreign exchange reserve that China has, is more than $3 trillion, and it has stayed at that point for the past 3 years. Whereas the current account surplus has increased. In other words, if we think about the aggregate official asset, reserve asset, not the official foreign exchange reserve that's being deposited in that account with the PBOC, but at the aggregate level, the official asset, you would have to count in all the foreign asset held by Chinese sovereign funds, from the China Investment Corporation to the various overseas investment agencies off the balance sheet, but affiliated with SAFE, or State Administration of Foreign Exchange. So from that point of view, China has more than enough financial power to defend the renminbi, although it may be costly, but I do not see further devaluation of the renminbi.
Great, yeah, thank you for that comprehensive answer there. Before we go on to ESG, which I'd like to touch on in the last 15 minutes, just a quick question, on the euro, and Antonella, it'd be good to hear how you're thinking about your allocation to the euro and the currency more generally.
Yes, we are a central bank with almost 65 to 70% of the reserves in euros. And this is mostly because of the trade relationship that we have with the countries that are in the European Union. And because of this high portion of the reserves in euros during the negative rates, we faced a lot of difficulties on creating return. And we have a big percentage of the reserves in cash. The immediate increase in rates, of course, has impacted our portfolios of our central bank. As I said, it is mostly the portion is mostly decided from our trade balance, but we find this currency attractive because as of now there are high rates, and there is moderate economic growth in the European
Sorry,
Union.
it's just I think there's your audio's been disconnecting, or not disconnected, it's crackling slightly. I'm not sure if there's something covering your mic.
Can you hear me?
Yeah, that's perfect.
Can you hear me?
Oh, yeah, I think that's better.
As I said, the immediate increase of rates has had an impact on our portfolios as well. We see this currency as attractive because of the high rates currently, as well as because of the expectation that in the European Union we might have a growth, even if it's lower compared to the growth in the United States. This is our view. Currently, of course, in the recent years, because of the high rates, we have increased our portion on euro-denominated instruments and reduced our allocation portfolio. But we have a positive outlook. A positive outlook, but an attractive currency, but I mean, our portion of reserve is decided mostly from the trade balance.
Sure. Yep. Thank you for that. I think it's your audio is still crackling slightly, but hopefully that can be fixed. And Didier, your views on the currencies. We've had a bit on the dollar, the euro, and renminbi here. What are your thoughts on this?
Yes, just one point. If any de-dollarization, it will be a very, very gradual process for political reasons and geopolitical concerns, and it was mentioned by my colleagues. So we do not expect an outright de-dollarization. The dollar has been very supported, in fact, since late 2021, and we believe that the geopolitical environment is probably still a supportive factor. Looking ahead from a pure macro standpoint, the fact that nominal GDP growth has peaked in the United States will probably offer opportunities to diversify away from the US dollar into other currencies, and we'll have a close look to all the currencies where central banks are not in a hurry to cut rates. So it's all about relative value, but clearly there is probably value in the forex space. But I think, let's be clear, the dollar will remain the predominant reserve currency in the coming decade. And the dollar will remain, I would say, the ultimate safe haven if you have a big geopolitical shock looking ahead. And even if investors want to diversify, they perfectly understand that there is no place to hide outside the US dollar. I would say in the foreseeable future, even if it makes sense to understand the fact that you get changes, I would say in the coming 10 to 20 years, but it would be a very gradual and slow process. And regarding the euro, we believe that the euro is undervalued at the end of the day. And we would expect a gradual reappreciation of the euro in the coming 12 months. Some, for instance, equity investors which were massively underexposed to Eurozone equities may take this opportunity to reposition themselves, and it can have an impact on the euro because there is a kind of cyclical recovery that is underway, even if it's a sluggish one as of now. Basically, for 2025, we expect a return to potential growth, and the cyclical lag between the US and the Eurozone should favor later in this cycle the euro versus the US dollar. So it could also be of interest for investors to think about the euro, also as a reserve currency in this environment, because the currency was clearly undervalued, and there is I would say the outlook has brightened of the past few months from an economic standpoint.
Yep, interesting. So I guess to paraphrase, the dollar is still will remain the king, but the euro is undervalued in the near term, perhaps. Yeah, thank you, Didier. I'd like to spend the last 10 minutes just touching on ESG, which is another chapter of the report, and how central banks are thinking about their allocation to sustainable assets. Ricardo, you were one of the co-authors on a piece that Banco do Brasil has written on this topic. It mentioned that you added green bonds to your strategic asset allocation in 2021. What are your thoughts on that space and your experience of investing in green assets so far?
Yeah, so we invest in green bonds for over 10 years here, but that was basically under our active management mandate, buying few SSAs to enhance carry and searching for some spreads. But recently, the Central Bank of Brazil has added sustainability as one of its on its official agenda, and we do have several different areas and aspects that the central bank is working in this direction to push that in our local markets, in the institution and regulation and other things. On the reserve management, we have a few changes. I would point out we now have two green bond portfolios, also including sustainability bonds, but US and Europe, they are not large because it's tough to find bonds with the ratings that we want and liquidity that we need within this space. But I think was a good change that we had a few years ago. We do follow CO2 metrics. We have embedded ESG within certain moves here. So we have, I can mention, we evaluate our counterparts on a yearly basis, And when we look at the execution, information that they can provide, back office, and now we have ESG ratings as part of this framework. We do acknowledge that ESG ratings are still not fully developed, but it's a way to push in this direction. So of course we still give a lower grade for this, but it's a way to show the markets that is something that is important to us and can become even more important ahead, as long as it keeps developing and give us more security to move in this direction. Last point I would make, it's on the communication, the transparency. Our central bank is known for being very transparent. As you can see, for instance, in our reserve management annual report in our website, we do have also a report on social, environmental, and climate-related risks and opportunity publication on an annual basis. So I recommend anyone to access our website and have a look at that. It's also something relatively new, but it's developing and it's getting better. And I think it's a positive signal that the central bank gives for its peers and especially the local investors.
Sure. Thank you for that. Antonella, I hope the audio connection's a bit better. I'd like to hear your thoughts on ESG and if that's something you're considering.
Yes. The importance of sustainable finance. Can you hear me, right?
Yes, yeah, it's much better.
Okay. The importance of sustainable finance has increased rapidly in the recent years. And this might be as a result of the growing evidence of significant change, climate change, and the rising concerns on social disparity. Evaluation has shown that it is very important to manage these factors, and there are benefits for the companies, there are benefits for the economy, and there are benefits for the planet. But these benefits are visible more in the medium and the long term, and this might be the reason why there are so many questions about ESGs. There is plenty of data and research that shows these benefits. Central banks understand their important role in promoting sustainability within the financial system and the economy, and they are including sustainability in the different policy frameworks, including here the reserve management. Bank of Albania has already reflected in its medium-term strategy its institutional involvement in sustainability. The challenge for us at this moment is to integrate sustainability in our mandate as the fourth objective, because central banks have currently managing the reserves based on three traditional objectives, which are liquidity, safety, and return. And let's say that sustainability would be a non-traditional objective, but we are working on to have this fourth objective in our mandate. We currently buy green bonds or sustainable bonds, but we don't have the mandate, and this is a situation in which we are right now. Some of the hurdles that we face.
So is that, just very quickly, so is that just passively because they hit other criteria on liquidity or others that have a holding green bonds?
So okay. Some of the hurdles that we face are related to the concerns of liquidity and return, greenwashing. There is also lack of obtaining data and the cost of obtaining it. So we are small central banks, and these, let's say, are the hardest zone. But the most important one is to insert it in our mandate.
Yeah.
But there is nothing that forbids us to buy green bonds. We can buy them, but
yeah, and I'd encourage others to read the report, because that's a trend we're hearing from many central banks, that they an increasing share.
We talk with other central banks, and especially small central banks are in the same situation as ours.
Yeah, they do hold green bonds, but perhaps not because they are consciously trying to incorporate sustainability.
There are no limits in the guidelines as well, or in the investment policy. So this is the reason why.
Thank you on that. Didier, a word on ESG from your side.
Yes, perhaps something that first on green bonds. I'd like to say a few things. Given the funding needs that we have at the global level that are huge, the green bonds are really needed, and we see an increase of appetite from all investors for this green bond market. It's a big component, and it dominates the sustainable bond market. And in April 2024, for instance, the green bond market has reached almost $2 trillion of outstanding amounts, which is 7 times what we had 5 years ago. And what is interesting is that we see that the green bond market is still dominated by euro-denominated, issuances, and that it reflects the fact that Europe remains, I would say, the leader with more than 40% of market share since 2023. And interestingly, you see that the performance of green bond portfolios is totally in line with their respective benchmark. And as a result, we have seen a very big investor appetite, on green bond strategies, and we see more and more also demand coming from large investors, central banks, and sovereign wealth funds. And interestingly, also, you see that when you look at the commitments coming from public investors, they are all progressively incorporating climate change into their investment approaches, and it's work in progress. I mean, it has started, and it's work in progress. If you look, for instance, at a survey that was conducted in 2023, more than 65% of these sovereign wealth funds and would not engage directly with portfolio companies if they do not, produce positive environmental outcomes. And this is a very different from what we had, 2 years ago, with less than 50% of the respondents that said that they would have engaged directly, and tells you something about, the fact that most investors at a global level become aware about, the need to finance the green transition. As I said in introduction, there are massive needs. And there is Amundi, we can accompany in fact our clients to commit to the net zero transformation in various manners. So on the one hand, you have
Sure.
the green bonds, but also we provide advisory. We help these investors to switch mandates from a traditional benchmark into ESG or climate benchmark. We propose a wide range, of climate ESG ETF, either for strategic or tactical asset allocation, and it's done, not only within the Eurosystem. We also have an increased, commitment to help, and to work with emerging, the so-called emerging countries. And for instance, Amundi has been appointed, as a management company of a very large supranational entity in Latin America, which project to launch, a series of ESG ETFs for central banks in Latin America. So as I told you, it's work in progress. We've seen, a very big change over the past 3 years, and we expect these changes to continue looking ahead with more and more demand for this kind of products.
Great, thank you. I'm conscious of time here. I don't know, Zoe, if you had a quick 30 seconds on ESG before we wrap up.
Sure. I guess I just wanted to bring back geopolitics here, in the sense that right now, indeed, our global economy, as well as the underlying infrastructure, is so very much based upon traditional hydrocarbon. So it takes time for not only takes time for the green transition, but also whenever geopolitics comes back to bite us, we started to again see private equities and a lot of the investors started to run again to revive their investment in oil and gas. So from that point of view, I do see the transition as still very much a tortuous one, rather than a smooth sail. But then again, if we think about the necessity, how the transition is going to be, a great case that comes to my mind is Saudi Arabia, because yes, the kingdom is trying to diversify, but in order to finance a lot of these green projects, you still need the underlying hydrocarbon economy, still need the oil money. So from that point of view, I guess I'll just end there by saying that there are, the green transition, oil and gas sector, again, is very much interdependent, rather than we can just get rid of oil today and quickly transition tomorrow.
Yep, thank you. That's a good point to end on. Yeah, this has been a fascinating discussion, and thank you to Zoe, to Didier, to Ricardo, and Antonella for sharing your insights on all these different topics over the past hour. And thank you all in the audience for tuning in. I hope you found that panel as engaging as I did, and yeah, I'd encourage you to download the report and explore more about what the central bank community are thinking about all these trends. If you do have any questions on the report or the GPI workstream more generally, please feel free to get in touch with the team at OMFIF. I'd also like to thank our partners on the project, to Amundi, to DZ Bank, CCB, and State Street Global Advisors, and to the team at OMFIF for all their hard work and efforts over the past 6 months to put this report together. The very final word from me is that the conversation doesn't stop here. We'll be welcoming 2 economists from the ECB who will be joining us to run through their upcoming report on the international role of the euro, which is something we just touched on today. They'll be joining us on the 19th of June. So yeah, if you're interested in signing up for that, please look into our website or please get in touch. But thank you to all of you on the panel once again, and to the audience. And yeah, we'll be continuing the conversation shortly. Thank you all.
Thank you.